In exercise 8-11, what we're going to do is calculate the bad debt expense, so the journal entry that you make at the end of the fiscal year, but instead of using the accounts receivable approach, we're going to use the income statement approach, and this is relying on a percentage of the sales in order to make the journal entry. So in requirement A, it says, Demron estimates that 1.5% of net credit sales will prove to be uncollectible. Prepare the adjusting entry required on December 31st, 2020 to estimate uncollectible receivables. So I'll show you how to calculate that 1.5% net credit sales figure. So what we'll do is we'll take our sales on credit of 480 and then subtract your sales discounts. And if you had sales returns and allowances, you'd put that in there as well. So remember, it's just your credit sales minus the sales discounts. So that comes out to $472,000 for net sales. And then we're just going to write off 1.5% of that. So if I take 1.5%, this will give me $7,080. So in this case, what we've done is we've calculated the bad debt expense. Whereas before, when we used the allowance approach, we calculated the balance in the allowance account. So I just want to show you specifically what we calculated. Bad debt expense. And that's $7,080. And if we're doing our allowance for doubtful accounts, then obviously the credit would be into that account. So under the income statement approach, we're always debiting bad debt expense and crediting allowance for doubtful accounts. So I'll go ahead and make my journal entry. So bad debt expense was the $7,080 that I calculated. And then the allowance for doubtful accounts, which is $7,080. And part B is asking us to prepare the entries for these transactions. So credit sales are $620,000, where the cost of goods sold was $4,600. So let's go and do those two journal entries. So remember, this system wants us to put them both in separately. So I'm just going to make a journal entry. So credit sales means that they're all accounts receivable, so we don't receive the cash right away, for $620. And sales for $620. And then my next journal entry, the cost of sales are $406,500. So I'm going to record cost of goods sold for $406,500 and take them out of inventory for $406,500. And now it wants us to record the sales discounts of $12,000 were taken when accounts receivable of $440,000 were collected and accounts written off during the year totaled $10,000. So let's do the discount. So sales discounts of $12,000. And we will do the collection of the accounts receivable. So I'll have cash here, and I'll have accounts receivable right here. So the accounts receivable again was $440,000, and we gave discounts of $12,000. So then the cash is going to be for the difference. So that will be $428,000. So you may be used to journalizing this one separately, because we could do that, calculate the discount separate from collecting the accounts receivable, but we'll just do it this way just because they want a combined entry. And then the last one is to record the write-off. So it's allowance for doubtful accounts. So remember, whenever we do the write-off, we just move it into another account. Allowance for doubtful accounts, which is the $10,000. And then just decrease your accounts receivable by that. So all the journal entries are the same under both the income statement approach and the accounts receivable or the balance sheet approach. The only difference is how we record the bad debt expense and how we calculate that. So I've got all my journal entries, and now what it wants me to do is calculate the December 31st, 2021 bad debt expense. So this is now at the end of the next year. So I'll just do bad debt expense and allowance for doubtful accounts. And I just have to figure out what my net sales are at. So let's just go ahead and do that calculation. Okay, so I'm just going to start off with my allowance for doubtful accounts. At the beginning or at the end of 2020, it was 1100. And then I made this journal entry for the bad debt expense. And so then at the end of 2020, I'm just going to total what's in this allowance for doubtful accounts. So I have 8180. And now what I'll also want to do is open up my accounts receivable. And see what balance that was. So it was 70,000 at the end of 2000. So I'll just say December 31st, 2000. And I'll call this December 31st, 2000. And then this was my adjusting journal entry for 2000. So now when I move into 2021, I'm just going to post all of those journal entries that I just did. So remember, the one was 620,000 to record the sales, and I'll open up my sales account for 2021. And that was 620,000. And then my next journal entry was the cost of goods sold in the merchandise inventory. I'm not looking at those, so I'm not going to open those T accounts. The next one was to record the collection. So I can open up cash here, even though it doesn't really matter. But remember, our journal entry was debit cash for $428. And I've got my sales discounts. So I debited my sales discounts of $12,000. And then I credited my accounts receivable by $440,000. And then I did a write-off, which was my allowance for doubtful accounts of $10,000. So I made a debit there. And then my accounts receivable, I decreased by $10,000. So when I'm looking to do the bad debt expense, so this one was for $2,000. We're going to look at doing the bad debt expense for 2021. all we're going to do is take our sales and minus our sales discounts. So let's just see what that ends up being. So 620 minus 12,000, and we didn't have any returns, so that's okay. So I have 608, and we're going to do 1.5% of that one. So that gives me 9120. So that's what I'm going to record as bad debt expense. So I'm going to open up another T account because bad debt expense, that one was for 2,000. And remember, all of our temporary accounts get closed into income summary. So then this bad debt expense account for 2021 is just sitting at 0 right now. But when I make this journal entry, I'm going to debit bad debt expense for 9120. And then I'm going to credit allowance for doubtful accounts for 9120. So let's go ahead and do that. 9120, 9120. And now it wants me to show what my accounts receivable looks like on my balance sheet at the end of 2021. So I'd have my accounts receivable, and then I'd subtract out the allowance for doubtful accounts, and then I'll have my net receivable. So let's just go back into my T accounts, and the good news is I've already posted everything, so I just have to add it up. So accounts receivable, so I opened in 2000 with 70,000. I sold on credit 620. I collected 440 and I wrote off 10,000. And so the final balance is 240,000. And that's what I'm going to put as my gross accounts receivable. And now with my allowance for doubtful accounts, we'll do the same thing. We'll take this 8180 balance at the end of December 31st, 2000, and then we'll subtract the 10,000 and add the 9120 and see what we get there. $7,300. So I'm going to go and move this 240 onto my balance sheet and this 7,300 onto my balance sheet. Okay, so I have 240,000 and minus 7,300. So my net accounts receivable is going to be 232,700.